Welcome back, everyone. Today is February 27th, 2026, and we are going to walk through some key technical levels that are shaping up across global and domestic commodity markets right now. Before we get into anything, just a quick reminder. Everything discussed here is purely observational and educational. We are looking at charts, reading price structures, and understanding how traders historically interpret these levels. Nothing here is a buy or sell recommendation. Always do your own research and consult a licensed financial professional before you place any trade. All right, let us get the chart up on screen. If you're following along with your own platform, pull up the WTI crude oil chart on the hourly or 4-hour time frame. As of today's session, WTI is hovering around the $65.60 to $65.90 range. Now, this is a very interesting zone for observers to watch because this area has been a battleground for the past several sessions. So here is what the chart is showing us. There is a well-defined ascending channel that crude has been trading within, and price recently pulled back to test the lower boundary of that channel. What technically oriented traders tend to look for in this kind of setup is whether the price can hold above the channel support and stage a bounce. The 38.2% Fibonacci extension level sits at around 65.63, and price is essentially hovering right there as we enter this session. The 50% Fib level is at 66.26, and the 61.8% level is sitting at 66.90. These are the zones that technically focused market observers tend to flag as potential near-term targets if buying interest holds up. Now on the resistance side, the 66.00 area has been a ceiling for this market across 2 consecutive sessions. Notice on the chart how price made 2 separate peaks near that level. That kind of double top formation is something technical analysts pay close attention to because it can signal that sellers are defending that zone. IF price struggles to reclaim 66.0. The neckline support around 65.0 becomes the next zone to observe. And below that, the 62.0 to 63.0 range is a much stronger structural support zone, one that served as a prior breakout level on the daily chart. Let us now switch over to the MCX crude oil chart for those watching domestic Indian markets. On MCX, crude futures are currently trading near the 6,039 rupee level. Now notice how the price has been consolidating just below a well-defined resistance cluster between 6,106 and 6,138. This is a supply zone that has produced repeated rejections in recent sessions. Smaller. Candle bodies near the top, some hesitation and momentum. Technically speaking, this is the kind of price behavior that suggests buyers are struggling to absorb the selling pressure sitting above 6,138. On the downside, the nearest support zone observationally sits between 5,900 and 5,950, with a stronger structural base along the ascending trend line that stretches all the way back to the 5,037 level. Now, let us zoom out and talk about the macro context, because technical levels do not exist in isolation. Crude oil's price action this week has been heavily driven by headline news, specifically around U.S.-Iran nuclear negotiations. Any development that suggests a diplomatic resolution could potentially bring more Iranian supply back into the market, which historically has been associated with price softening. Conversely, if talks break down, the geopolitical risk premium tends to get priced back in quickly. This is why traders who track crude technically often keep one eye on the news flow as well. Moving on briefly to gold, on MCX, gold futures are trading near the 159,861 rupee level. The 160,000 to 162.10 zone has been acting as a consistent supply barrier with multiple rejections visible on the chart. Support is observed around 156,000 to 158,000. Now let us talk about risk management concepts because this is where newer market observers tend to skip the most important part. When technically oriented traders identify a potential setup around a support or resistance level, they are not just looking at the entry point. They are considering 3 things simultaneously: where the trade idea is invalidated, what the potential reward looks like relative to that invalidation point, and how much of their total capital is being risked. For example, imagine a trader observing WTI crude near the 65.60 support level. That trader would historically consider what happens if price closes decisively below 65. Farce. That would arguably negate the bullish channel bounce thesis. So the distance between the entry observation and the invalidation point is roughly 60 cents. Then they compare that to the potential distance to the first target at 66.26. That gives a rough ratio to evaluate. Most technically disciplined traders, while still discussed in trading literature, talk about only participating when the potential reward is at least 2 to 3 times the defined risk, a concept worth understanding regardless of what markets you follow. Position sizing is the other side of that same coin. Market educators consistently emphasize that knowing the level is only half the picture. T, the other half, is understanding how much exposure makes sense relative to total capital, so a single adverse move does not cause outsized damage. Many trading textbooks suggest individual trade risk should stay between 1% to 2% of total capital. This is educational context drawn from widely available trading literature. Coming back to the chart one final time. The 100-day simple moving average is above the 200-day SMA on the WTI chart, which technically suggests the broader path of least resistance may favor the upside on a higher time frame. However, the shorter-term double top near 66.0 introduces caution. These conflicting signals across time frames are very common and are a reminder that no single indicator tells the complete story. As we wrap up today's walkthrough, here's a summary of the key observational zones we covered. On global WTI crude, the resistance cluster sits between 66 and 66.90, with support observed around 65.0 and the stronger zone at 62.0 to 63. On MCX crude, resistance is between 6,106 and 6,138, with support around 5,900 to 5,950. MCX gold faces supply between 1.60,000 and 1.6210, with support near 1.56,000 to 158,000. Remember, charts are a tool for observation, not prediction. Price can and does move in unexpected ways, particularly in a headline-driven environment like the one crude oil is navigating right now with geopolitical developments around Iran and the broader macro backdrop of a projected supply surplus heading into mid-2026. Stay observant, manage your risk framework carefully, and keep learning. We will see you in the next session.